Here we are at 5070 on the S&P 500, record highs. And the interesting question to ask yourself is, how does a company like Nvidia guarantee growth in a company like Visa? Here's what you need to know before the bell this morning. Markets sold off on Wednesday, heading into the earnings report for Nvidia. Earnings from Nvidia really just did extremely well. They posted great earnings, but the interesting thing was the entire market jolted higher on Thursday, up 2%, setting all-time high. Friday, we managed to rise just a little bit further on Friday, closing at an all-time high. So again, here we are at 5070 on the S&P 500, record highs. And the interesting question to ask yourself is, how does a company like Nvidia guarantee growth in a company like Visa, right? And so this, the whole market jolted higher because of Nvidia's earnings, but this is just that whole exuberance that we've now pegged into the market. Call option volume on stocks is reaching very, very high levels. We are reaching levels of kind of investor sentiment and exuberance that are extremely high levels. Positioning by portfolio managers are very, very long equities. And again, this isn't a bad thing, and it certainly suggests that that's where we are currently in this kind of momentum-driven cycle. And again, there's absolutely nothing wrong with the markets for right now. And again, no reason to be, as we've said before, no reason to be overly bearish. This 20-day moving average continues to be the running trend line for the markets right now. And until we violate that 20-day moving average, there's not much to be concerned with. Now, again, the markets remain very overbought on multiple levels. So again, upside is going to be a bit more of a challenge. Doesn't mean we can't just kind of keep grinding higher. And that's what we've been doing here, running really kind of fairly defined channel from top to bottom. So now we're back to the top of that channel, probably get a little bit of a sell-off, come back down here towards the 20-day moving average. The key thing to be looking for here from a risk management standpoint is if we take out this 20-day moving average, that then sets up for potentially a bigger contraction in the markets. And again, this market action that we have right now is extremely similar to what we saw last year when we were talking about the issue of the Silicon Valley Bank bailout back in March of last year. The markets began a fairly strong rally that did kind of exactly the same thing last year. Had just a kind of a grinding run higher here. And then, of course, as we got into July, which is where markets had gotten extremely overbought, extremely extended, everybody's very bullish. Back here was also the AI chase as well. If you remember, this is back when really the AI story really came to fruition. Everybody's like, oh, AI is going to change the world. We had ChatGPT and everybody was all excited. And then the markets went through about a 10% correction over the next several months before we got into the current advance, which again is very similar to the advance that we saw running up into July of last year. The steepness of this advance is a bit sharper than what we saw last year. But at the same time, the markets remained very overbought for an extended period of time. And again, kind of the same structures we're seeing today is very similar to what we saw last year. So again, the point still is that at some point we are going to get a contraction of some sort, 5 to 10% correction sometime over the next few months, very, very likely. So again, we continue to suggest a bit of risk management here in your portfolio. But that's what you need to know before the bell this morning.